Cool, thank you. Just waiting for the recording to kick in. I see that it has. Wonderful. So let's kick off. So welcome once again to the APC Bridging course for the year 2025. Today, it comes as no surprise because of the agenda for the day. We're going to be unpacking IFRS. And I guess before we get into the nitty-gritties of it all, I just wanted to get a sense from you. So again, already interacting. What do you expect from this session? When you saw the agenda item, when you saw the sort of course program, and you saw this particular session, what is it that you thought you would get out of this session? Again, no right or wrong answers, just personal perspective.
Hi, good. Yes, good morning. So this is Tom here.
How's it, Tom?
I'm good. Hey.
Good.
So, as for me, late last year, towards the end of December, I also took part in the introduction session to the ABC course, and through that, I think Rendani, in a way, tried to unpack what the session will entail, where essentially he advised that during this session, we then get the chance to really understand and also get the view in terms of how we can make use of these voluminous textbooks, especially given that when we are writing the final examination, they form part and parcel of our authorized authorized items that we can bring with during the examination. So he said, during the session, we are going to essentially learn how we can make use of these books to our own advantage, and also how these books can really assist us in answering any question that comes our way. Yeah. So essentially, in a nutshell, my expectation is that during this session, I should be able to understand how these books can be useful to me, and also how I can also use the books, to really master and understand IFRS. As Rendani said, that it's supposed to be an enjoying subject. So I'm really looking forward to really get that that feeling to say that I should, or I will be able to really enjoy this subject after the end of this session. So yeah, in a nutshell, I'd say those are my expectations from my side. Thank you.
Awesome, Tom. Thank you so much. And you covered so much in there, and a lot of very important things, and of course through the lens of Rendani, but still making it your own in terms of expectations. So yes, it is an approved resource that you have to take with you in the exam. But as with these resources, it's a very fine balancing act, because as you described them, you described them as voluminous books, right? Like there's so many books, and they can be a resource to help you to success in the exam, but at the same time they can also essentially bring you back a little bit, just because of how just because of the voluminous nature of the book. There's just so much information in those books. So what exactly one of the key sort of objectives of the session is to do exactly that, to help with being able to whittle down those books, understand what's sitting in what books, how are they structured, so that when you have a specific issue in mind, a specific problem in mind, and we'll speak a little bit more about issues and problems shortly, you know exactly where to go in the book to get the answers that you're looking for, and of course the rest of the books become absolutely irrelevant. I think another important thing that you mentioned there, Tom, was around answering any question. And I think that's another key shift of thinking that we're going to try capture in this session, albeit maybe a little bit briefly, is that it's impossible for you to read and understand and master, but by the back of your hand, everything that's sitting in those books. But it's just too many books, and that's just accounting, right? So you're going to do the same for tax. Are you going to do the same for auditing? Right? It's just not going to happen. So what we need to get better at, especially at this stage of the game at APC, is the how, the process. That's what we're going to focus on. So what is the process of unpacking an accounting problem and using the books to help you answer an accounting problem and report information to the user of financial statements? Once you understand the process, then it matters not what problem we present to you, because when you have a problem or an issue, which again we'll unpack, you're just going to know exactly how to pick up your books, or other resources that are also available that we'll speak about throughout the course of this program, to almost answer those questions or tackle those accounting or reporting problems. So again, we're going to be focusing a lot on process today and less about the actual content of the standards. But of course, we're going to be using the contents of the standards and some real life examples, just to give you a feel or a flavor. So thanks for that, Tom. Really important expectations from your side. Koleleni says, to find understanding first easier, because wow, I used to carry the books and still fail. Yeah. So understand how IFRS works, much easier, absolutely. And also in that understanding, helping you understand IFRS in the particular sort of problem that you have. And yes, hopefully we'll make carrying those books around worth it for you into the exam. Larry, mastery of IFRS so as to meet the final assessment's competency requirements. Absolutely. So mastery of the process of dealing with IFRS is going to be a key sort of outcome from the session. So before we jump in, just a couple of objectives. Thanks everyone for contributing. So understand what the purpose of IFRS is. So as with everything, just as like a general principle in life, understanding the why is always very important, and particularly when it comes to accounting, right? So it's less about a tick boxing exercise. Accounting is not a tick boxing exercise, as we'll come to learn throughout the course of the day today. And always understanding the why is extremely important when it comes to applying accounting principles, and insofar as understanding how IFRS works. So first, we're going to kick off things off with just understanding what the purpose of IFRS is. And then we're going to just talk a little bit about rules, principles, and judgments, all very different concepts. And we're gonna speak a little bit about together, unpack a little bit about how all of these three concepts, or what they all are. Can they coexist, or is it something that cannot exist in one place? Then we'll get a little bit more technical. So we're going to use a simple example, a fictitious example, just to develop a systematic approach to dealing with financial reporting issues. And the use of the word financial reporting as opposed to accounting is deliberate, and we'll talk a little bit about that in the session as well. Then we'll dive a little bit deeper into the role that professional judgment plays, because I think this is the key element of accounting, almost like an unsung hero, if you want to call it that. But in the real world, and APC, as you know, tries to simulate the real world, accounting judgment is an intricate part of applying these accounting principles, or these IFRS principles. In fact, it's so important that as a note disclosure, IAS 1 requires that entities disclose their critical accounting estimates and judgments, right? So that the users of financial statements, and here at the risk of spoiling a little bit of the session, so spoiler alert, so that the users of financial statements can understand where the accounting risks lie, right? So and we'll unpack a little bit about that later on. Then as we go throughout the session, we're always going to learn from real life scandals and challenges. This is quite nice to do because it gives you it gives you an indication of the relevance of what we're talking about today, and the profession that you're joining, and the importance of this profession in the corporate or in economies at large. We'll touch on a little bit about how places where things didn't go right. Then lastly, back to Tom's point, and I think even in the chat as well, there was a little bit of it going on, just to inspire that confidence, right? So there's a lot of fear, which is perfectly justifiable. So don't get me wrong. It's a big unknown. Accounting is a difficult topic area. Those books are massive. There's a lot to be fearful of, validly so. So I'm hoping this session will just give you a little bit of confidence, not to completely eliminate those fears, because that potentially is not possible. And a little bit of fear is always a good thing. But just inspire that confidence and inspire you in this profession, and hopefully you like I will take your career in the world of a technical accountant. But of course, I'm sure there's a lot of auditors in here, and I'm sure there's a lot of people that would rather use their CA to do something completely different, like corporate finance or something else. Right. Let's jump right into it after running through all of those objectives. So I've got here on my screen a sentence that says the science and art of IFRS, from principles to practice. So the last piece is what we're going to try focus on in the session, practice, right? So we're going to be doing a lot of practical things. So my slides don't have a lot of diagrams in them. They don't have a lot of extracts from standards in them, but I have the accounting standards here. So we will work through the accounting standards together. So we'll do things practically. But I am curious about your thoughts of the first sentence, the science and art of IFRS. And I want to pose a question to everyone this morning. Is IFRS or financial reporting an art, science, or both? Can I get some thoughts? No right or wrong answers, as always. Just want to unpack it with you all. And why? Why? Thank you so much, more blessing for the response. But in the spirit of my first objective and the importance of that word why, I would also like whys with my responses. So everyone that's in the chat, you have a responsibility, like Ledima has done, to respond, which I'm very grateful for, but also respond with reasons. And also, can I hear voices? So I would say both art based on judgment aspect and science based on principles. Okay, interesting. Any other thoughts? Yeah, I'm curious though. Go for it, Amos. You're more than welcome to jump in.
So to me, it's a bit of both. So on the science part, my observation is that the standards tend to have a systematic approach. They are well structured in how they are presented to us for us to actually learn and use and apply them in a systematic way. So on that side, then to me, it's a science. Then on the art part, we then the users of those IFRS have to apply our minds to solve problems. And that application of our minds, to me, needs our creativity and judgment. Yeah, so that's my contribution. Thanks.
Yeah, thanks, Amos. Yeah, an amazing contribution, and that's exactly it. And I like how you, without repeating what you said, I like how you almost flipped from when you went to art. You said it requires us to apply our minds to solve the problem, to apply our creativity and our judgment. And I like how you reframed it. So you went from science in the books, art, that's my responsibility, and that's an important relationship that you always need to bear in mind. And I get the feeling that the sentiment is shared in the chat, and I will read all of the comments shortly. But reading the books, extracting the principles in the books or the rules in the books is not the extent of the work that we need to do throughout the year. The bulk of the work will come through what you do with what you've extracted. So how you problem solve, how you use your creativity and your professional judgment to actually apply the accounting requirements will become extremely important. And it looks like that sentiment is shared with. Let's have a look. Yeah. Ladima share the same principle, the same sort of sentiment. But what I find curious about Harry has said, which is also quite similar, is Ladima said science is principles, and Harry said science is rules, right? And I'd like us to just think about that a little bit. Is there a difference between a rule and a principle? Okay, just digest that. Cool, but thanks for application of those rules. No worries, Harry. But thanks for contributing nonetheless. Science got about rules and principles. As Larry says, rules and principles. So clearly, Larry thinks there's a difference between the two. And we'd be curious to hear from you, Larry, if your mic is working. Since you use both words, what in your mind is the difference between a rule and a principle? More blessing. Science is for structured rules and an art for professional judgment. Sorry, science is for structured rules and an art for professional judgment required by application. Agreed. Heather, I think it's both because in the science is when you are able to analyze the information, but on the art now implementing it to meet the requirements for the end users when you present it in the form of financial statements. And I like that part. Thanks for adding that, Heather. So now we have this extra element of, yes, now we account for something, right? So we do debits and our credits. But then how do we then present that information to our end users? Now that word presentation means something specific in accounting. And then what is then the difference between presentation of issues in the financial statements to disclosing information in financial statements? Something that we're going to go ahead and unpack. Larry, back to you. Any thoughts, or do you want to share if you think there's a difference between rules and principles? Yeah, I'm gonna suspect that you are typing because you don't unmute your mic. So while you do so, I'm going to go to my next slide. So Tom used the word creativity that we need to apply when practicing the art of IFRS. But it's unfortunately, even though creativity, I guess, is an important element of sort of applying judgment. Creativity can sometimes go a little bit too far. We've got a few corporate scandals on the page, and I see Amos here has shared some thoughts on principles versus rules. So principles are some guidance that help you to do the right thing. Rules are imposed and must be obeyed to the T. Absolutely, spot on, right? So rules, think tax, your legislation, right? It says if you got a transaction that does this is what you need to do from a tax perspective. If not, you don't do that. You do something else. Tax or legislation is very rules based, right? It does get a bit gray, of course, when things aren't defined. So you can have case law and stuff, and maybe a little bit of judgment creeps into tax. But or rather, yeah, from the principles. But generally speaking, legislation like tax, your experience, is very rules based. IFRS and similar to tax, US GAAP, which you don't have to worry about, is another accounting framework that's also very rules based. and hence some of these scandals that you see on the page. Principles, however, oh, sorry, no worries, Larry, but thanks for contributing nonetheless. Principles, however, are a form of guidance, to use the word Amos is used, that give us almost like beacons that we can use to then apply our own professional judgment when applying the principles. So the benefit of rules, black and white, you're in or you're out. The benefit of principles is that it's generally quite tricky to draft rules that cover every single fact pattern or every single issue. And it's also very difficult for rules to keep up with a very fast developing world like our world is these days. So principles has the advantage of not prescribing sort of rules to a T, but it allows you to use some of your professional judgment to then almost fill in the gaps and to say, okay, fine, what is the spirit of this requirement? All right. What is this requirement trying to achieve? Why is this requirement written in this way? Why, if I have these certain facts and circumstances, do I have to account for it in this way? Understanding that, then you could have a fact pattern or a problem that doesn't necessarily fit the squarely in an accounting rule. And understanding the spirit and the why of the requirement, you can apply your professional judgment to account for a transaction that may not necessarily be covered by a particular IFRS. So you see in this world of principles, understanding the why is crucial because you're not dealing with rules. In tax, you can get away with, okay, just memorize all the rules. If I tick all these boxes, then I do that. If I don't, then I don't do that, right? They're like the physical present test for residents in tax, right? You're either physically present or you're not. You count the days, assuming all those other case laws don't work. You count the days, either you meet the requirement or you don't meet the requirement. Black and white. You don't even need to know why they chose 183 days in a year and 183 days for the preceding 3 years and I can't even remember what, and a total of something. I can't even remember what the rest of the requirement. You don't need to know why, right? It's half the year. It's interesting, but you don't need to know why, and you could get away with it. From an accounting perspective, it's important to understand the why, because that will help you when dealing with accounting problems. So it almost adds another sort of element or responsibility on your end when you're dealing with accounting principles. Let's read Larry's response. But the difference in the sense that rules are hard and fast rules that one has to precisely follow, absolutely. Whilst guidelines are a bit flexible and they allow for interpretation. And I like that word that you used, Larry, interpretation. We need to interpret principles. We need to apply rules, right? Very different sort of thinking between the two. So back to my corporate scandals. So we've got Lehman Brothers there on the top left. That was during the financial crisis back in 2008. Lehman Brothers was a financial services institution that collapsed. We got Enron on the top right. This was an energy company that, again, corporate scandal, also collapsed. I think this was way before my time. I mean, Lehman Brothers, I was just entering into the world of, or rather, I was just leaving the world of high school. So that was, I guess, I was just before my time a bit. Enron also way before. I think it was 2001. Energy company collapsed, corporate scandal. A few more closer to home. We've got Steinhoff. I'm hoping and I'm sure we all remember this one back in 2017, I think it was, or 2018, where Steinhoff has it collapsed? Can't remember whether it's still chugging along, but I think it's pretty much dead. And then Tongaat is still chugging along, I believe. But yeah, quite a few accounting irregularities there and some fraud. I think it was back in 2022, 2023. Can't remember exactly when it was. But ultimately, or I guess let me ask the question rather. Do any of these scandals ring a bell to anyone? And does anyone know what, from an accounting perspective, happened in any one of these scandals? Or if I missed a scandal, I think there was another one in South Africa that I may have missed. I can't remember. That I may have missed. Does anyone know what happened? No? Does anyone read the news? More generally.
Sorry, this
Hi,
is Cecil.
Go for it.
On Enron, I think I can. I mean, with Enron, it was an element of the ethics of the auditors hiding or did their work, and they got too close to the executives and were able to not really apply themselves and show that independence. While Enron was also, I guess, having a lot of all off-balance sheet transactions that were not properly maybe disclosed and reported on.
Yeah, and yeah, in a nutshell, says so that and I just focused on the accounting element. So obviously a lot went wrong. That Harry's also sharing, and you also shared audit independence, ethics, sort of corporate governance failures. Of course, a lot of things went wrong for Enron. But in the spirit of what we're talking about this morning, is exactly what you pointed out on. There were a lot of off-balance sheet activity happening. So in other words, there were transactions that were happening that were not being reported on, specifically debt-related transactions. And without going into the nitty-gritties of it, because it involves subsidiaries and very complex accounting, there was also sort of the inflating of profits that was also going on. As a result of all that off-balance sheet activity. So that's ultimately what happened to Enron. Lehman Brothers, we'll dive into a little bit deeper again. There's a lot of things that happened for it to collapse. But we're going to go into the nitty-gritties of or not one. We're going to go into one example of Lehman Brothers, which I thought was quite nice. Edward and Tongard, overstated assets and profits and premature revenue recognition, right? And Harry for sign off. So let's deal with Edward first. Absolutely. So overstated assets, so valuations of assets. Again, the valuation thereof or impairment testing is an accounting judgment, right? There's you're not going to find in IFRS a rule that says if this happens, then you must perform an impairment test, as an example, right? It gives you the principles of what an indicator of impairment is, so guidance, right? And then it gives you some examples of what could be indicators of impairment. So naturally, as when we're applying our judgment as accountants, we rely on those examples to give us an indication. However, you will see in the standard, and again, let's make this practical, that the standard is very clear to say, and I hope the standard doesn't embarrass me. But I'm pretty sure it says very clearly that this is not an exhaustive list. But let's have a look here. Right, there you go. So the standard then goes about a whole spiel about giving information about when an asset may have an indication that it may be impaired. And then it says, okay, now that I've given you the principle, here's a couple of examples of things that you should consider as a minimum. So a little bit more prescriptive, but it's as a minimum. Here's a list of things that could potentially indicate that your asset may be impaired, right? However, that doesn't mean that this is an exhaustive list. So it means that when applying our own professional judgment and understanding why this accounting standard exists, so IAS 36 exists, to ensure, so let's go back to the objective of the standard, to ensure that assets are carried at no more than their recoverable amount, right? That's the key objective of IAS 36, right? So we know why this accounting standard exists, and to achieve this objective, it has this principle of identifying when an asset may be impaired, right? And it's got this non-exhaustive list of examples. Now, if I work through the list, and my particular facts and circumstances isn't necessarily on the list. However, as management, I still believe that there is a risk that the asset that I have, whatever it is, may still be may have a carrying value that exceeds what the standard defines as its recoverable amount. Therefore, using my professional judgment and understanding the why of the standard, I would still perform an impairment test. Right. So this is a little bit of a practical example there, but it doesn't stop there, right? Because maybe they did perform impairment tests, right? But then we need to apply more judgment, because now we need to estimate, right? Estimations involve an extreme amount of judgment, right? We need to estimate a fair value, and we need to estimate a value in use as another example, without going through the technical details of what all those two terms mean. Again, with that judgment that's available in the standard, there's an opportunity again to be a little bit too creative and make judgments that ensure that there is no impairment of the assets, and therefore results in an overstatement of the assets on Tonga's balance sheet, and results in a corporate scandal. Profits and premature revenue recognition, I think all of that, we can sort of see how that could go wrong. Steinhoff, we've got off-balance sheet events, but also misrepresentations that misled investors and ultimately led to its failure. Okay, absolutely. So without going to the nitty-gritties of, because again, a lot went wrong with Steinhoff, but one of the core issues was what Harry is describing, is all these off-balance sheet structures and subsidiaries that were all in the group that caused all the issues. And absolutely, and Ledima there has all the specific details of how those sort of off-balance sheet vehicles were used to sort of mask these transactions. But I don't want to digress and go into that much detail, but thank you so much, Ledima, for sharing that in the chat. So, with this in mind, what then is the purpose of financial reporting? Now that you have an idea of what can go wrong and the role accounting can play, right? I saw misled, I saw misrepresentations, I saw fraud, I saw cooking the books. What then is the purpose of accounting? Financial reporting, sorry. What's the purpose of financial reporting? Anyone? What do you think the purpose of financial reporting is? Why are we all here? Why do we put financial statements together?
The purpose.
I can hear you. I'm not sure who that was. You just went on mute.
Sorry, Lerato speaking.
Hi, Lerato.
The purpose of financial reporting is to present financial information that is relevant, accurate, and valid, fairly presented so that the users can understand it.
Absolutely. And the users can understand and do what with that information?
To make decisions.
Absolutely. And that's a perfect summary, right? So what we're trying to do here ultimately is to facilitate decision making. Right? That is the core. Decision making of who? stakeholders. Stakeholders can be who? Governments, investors, which could be pension funds, also governments. It could be regulators. It could be us as a general public. It could be creditors. It could be anyone that wants to make a decision regarding a set of a company. Financial reporting there is there to try and facilitate, or at least partly facilitate, making that decision. To do that, information that needs to be provided needs to be relevant, right? And needs to fairly present the economic reality of an entity's performance, financial position, and cash flow. So I'm going to skip over a little bit. My slides are not in order. Apologies for that. All right. And I lost my train of thought while doing so. Yes, the economic reality of a transaction, and I think, and I can't stress that point enough. The objective is to fairly present the economic reality of transactions or events, right? And that economic reality could differ from the legal form, could differ from I lost my train of thought again. Could differ from the legal form, could differ from when cash flow actually moves, right? The economic reality of something could have an impact or could be relevant before cash is out the door. It could be relevant when a contract is signed. It could be relevant when you make a verbal agreement, right? It could be relevant when an external event happens, right? When there's a storm or there's COVID-19. The economic reality of transactions is an extremely important concept. And with that, and I'm glad you all gave me wonderful responses about what happened in all these corporate scandals, is because it is really important that we are, how can I describe this? I don't want to use the word economics, but it's important that we are holistic, or we start becoming holistic corporate professionals, is how I'm going to describe it. Because we need to for you to be able to reflect or think about or question the economic reality of something, you need to have the background to do so. So you need to understand how loans work, or you need to understand how a business works. You need to understand how so all of these small little things that drive the world of commerce will become extremely important when trying to think about the economic reality of something. You need to understand how a lease works, et cetera, et cetera. So just to read what is on the comments and what's on the slide. So in the comments, I've got to record transactions and present financial information to users, to report financial performance, financial position to entity stakeholders, yep. To fairly present operational results, financial position and reported users, yep. To see the overall performance of company and present information to all stakeholders to be able to make informed decisions. So thank you for bringing in that decisions part. From IFRS. So IFRS is essentially a framework for the preparation and presentation of high quality, comparable and transparent financial information. Right, the word transparent becomes very important when you think about those corporate scandals and all of that off-balance sheet activities. With financial information, we want to pierce the veil almost and see what's happening inside this company. Right? IFRS aims to enhance decision-making by investors and stakeholders, ensuring financial statements reflect the economic reality, not the legal form, not the timing of transactions. We're looking for the economic reality of the transactions. For information to meet this sort of objective, qualitatively, it has to be relevant information. In other words, it's capable of influencing a decision. So materiality will sit in a concept like relevance, right? If you've got a R1 billion company, a company that has R1 billion in revenue, and you've got a transaction that is for R2, right? Chances are whether or not that R2 was given away or went missing, it's not really going to change your mind. I mean, maybe you may think about corporate culture, etc., depending on how that 2 rand went missing. But the point I'm trying to make is quantitatively, if you just have a quantitative lens, it's unlikely that a 2 rand transaction will worry you when an organization generates revenue of 1 billion, right? That 2 rand information or economic event or reality, it's gone, will not influence your decision. Therefore, it is not relevant. Therefore, it has no place in the financial statements. Or rather, not that it has no place in financial statements, but rather IFRS does not deal with that information. So if information is of material, IFRS is not applicable to that transaction, right? Which always feels like a weird thing to say, right? So materiality as a concept is quite important. Then, of course, faithful presentation, so complete. So, of course, all those missing transactions, all that off-balance sheet activity shows that the financial statements will not compete. Therefore, they did not faithfully present what is going on in Steinhoff, as an example. It's neutral. So when you apply our judgment, we shouldn't be biased, right? So, an example I gave about impairing the assets, I could have a bias towards assumptions that that increase the fair value or value in use of my asset. Therefore, less likely I need to impair my asset, right? So that's where bias can creep in when applying judgments. So when applying judgments, we need to make sure that we're neutral. And of course, free from error, right? Nobody wants mistakes in the financial statements. Mistakes take away from the usefulness of information. But of course, errors are very different from fraud. All right. So let's go back to a simple example. Let me look at the time here. Okay. So I think we're still looking good from a time perspective. And let's unpack a little more this concept of economic reality, and then we're gonna unpack it from just a commercial lens. So we're just gonna wing it essentially, and then we'll go look at the accounting standard that deals with this problem, and then we'll see how that rules, principle, judgment sort of interplays again in terms of how these standards work. Cool. So Lehman Brothers during the global financial crisis and what is known as the Repo 105 scandal. Now, Lehman Brothers is an entity that operated in America. So they applied US GAAP, just as a big caveat. So ultimately they relied on with this Repo 105 scandal, they relied on a loophole that is since very strictly closed by the FASB, the Financial Accounting Standards Board. They are responsible for drafting US GAAP. However, it is still a sort of fact pattern that is worth discussing, even from an IFRS perspective. And then we're going to see how sort of the principles interplay with this particular fact pattern. It is financial instruments, so a little bit technical, and I know we generally don't like financial instruments, but then we'll learn about another concept of thinking by analogy, which is a useful skill to have when dealing with accounting issues. And also financial instruments are not going anywhere. It's a core part of how businesses work. So just as a general sort of plea, it's one of those standards that we're going to have to make sure that we are at least at the base level comfortable with. Cool. So let's jump into what happened in Lehman Brothers. So Lehman Brothers, like I mentioned, was a global investment bank that collapsed in 2008. And it was one of the largest corporate failures at the time, and really was a really critical moment in the global financial crisis. Again, many things caused Lehman Brothers to collapse, but one that's particularly relevant for our session this morning is what is known as this Repo 105 scandal. So what is a repo? So as Lehman Brothers is an investment bank, they naturally hold a lot of securities. Now, a security, if you're not aware already, is essentially just, it could be shares, it could be a bond, it's some sort of financial instrument. that the entity owns, right? So Lehman Brothers legally owned these shares or bonds, and for the sake of this example, let's assume that Lehman Brothers owned shares. Let's say they own shares in Apple, as an example. So Lehman Brothers, as part of this transaction, in order to raise cash, so the reason why they were doing this was to raise money, right? Or naturally, as you are aware, when you sell something, you receive consideration in return, you're raising money. Because obviously they were in a bit of a tough spot. So they would legally sell these securities. So they would legally sell these Apple shares to another party for, let's say, $100. However, as part of that agreement, they had an obligation to buy back that exact Apple share, right? Now, of course, there are a lot of nuances when it comes to securities. Those people that trade in shares will know. But let's ignore those nuances for now. They have the obligation to buy back that exact Apple share at a later date, let's say 3 months down the line, at a fixed price of 105. So, and that is irrespective of what the share price in Apple does. So whether the share price of Apple goes through the moon and triples over the 3 months, or whether it literally tanks and loses all of its value in the space of 3 months, doesn't matter. Lehman Brothers will have to buy back that Apple share at 105 rands, right? The buyback is an obligation, right, as I've described it, and it is at a premium of 5 rands, $5, sorry, in 3 months' time. Okay, we've already unpacked and answered question number 1. Question number 2. In the context of what I just described, do you think Lehman Brothers, or rather, let me ask an open-ended question. How do you think Lehman Brothers should account for that transaction? That sale with that immediate obligation to buy back. And I don't want, you don't need to give me like a technical principle. I don't want paragraph references. All I want is just economically, what does this transaction look like, smell like, feel like? Does it feel like a sale? So should Lehman Brothers account for a sale? And then only in 3 months' time, then account for a purchase of the shares again? Or is it something else that's going on here? Mulalo?
Morning.
Morning.
From where I'm sitting, this does not look like a sale
Mm-hmm.
because if you've got that obligation to go and buy it back at a specified date, then you can't necessarily call it a sale because at the time that you're going to buy it back, you would not have, how do I put this? It's like you short-circuited that sale because you've potentially said you've sold something,
Yeah.
but then you go back and buy it, and you buy it at even a premium. So on the other hand, you are going to have this revenue amount of 100, but then when you go buy it back, you are $5 short. So I don't think I would consider it a sale.
Right. And I love how you describe all of that because what you did was you say, okay, this is what I understand from my perspective, my commercial perspective of how sales work, right? A company will make something or own something, will sell something, and that's it, right? I've got the money in, or maybe I have a receivable, worst case scenario, but I've got the money in, and that's it. Done, sealed, delivered, customer enjoys whatever they bought. I go use the money to do something else, maybe buy more of this thing that I just sold, or maybe invest in something. That's how sales work. But here, I make a sale, and then and I like how you described it. Like, and you go and short circuit that sale and say, okay, but hang on, in 3 months' time, I'm going to buy the same thing back. But we're still, I'm going to buy it at a premium. Therefore, I'm out of pocket of $5 from a cash flow perspective. That's not how sales work. Now, long story short, Lehman Brothers were treating these transactions as sales, right? But what Mulalo has described is how these transactions do not reflect the economic reality of a sale. They look like something else. So the objective of IFRS then is to then to provide principles that would allow for a transaction like this to be captured in a way that reflects its economic reality. So, an even harder question. I mean, the question that Mulalo answered is equally hard. What is this thing not? It is not a sale, right? Because it doesn't reflect the economic reality of the sale, right? So that's a very hard question to answer. And a key part of applying judgment when applying accounting principles. But then what does it look like? So if it doesn't look like a sale, the other hard question is, okay, what is the economic reality of what Lehman Brothers is doing here? Go for it, Lerato.
For me, it looks more like you're going to a mashonisa and saying, I have this pen that that has this value. Keep it, give me money because I don't have money. And then I will pay you back at 105. That 5 rand is interest. And you have to pay it back, otherwise you get your kneecaps broken. So that just
yeah, no, so continue.
So that's what it is. For me, there's an element, there is a liability in there. And it's not really revenue. Somebody's just holding something for you. They're just giving you cash. That asset, you're just getting some liquidity or something for whatever reason.
Yeah, absolutely. And again, I love how you described it because I like how we're all like using our commercial knowledge and just and you're analogizing to things. So the word analogy is also another word that I want to unpack here. So you analogize to going to a mashonisa and with a pen, I think you said, and you're giving them the pen, they give you $100. And then 3 months later, you need to come back with 105, and then they give you back the pen. And if you don't, they break your knees. But I guess in this case, in the commercial world, the other party won't break knees, or rather, they'll just keep the pen, right? And in this case, they'll keep the shares. So Tom has sort of added on to that and said, it seems like it's a loan with interest, which is what Lerato described. Exactly that, right? The substance of this is that it's a secured borrowing. Right? We have used our pen in Lerato's example or Apple share in this example as security. So we're legally transferring it to the other party, to the mashonisa. And they are giving us cash, but they legally own this share and they're holding that as their collateral or as their security. So that if you don't pay back the 105 in 3 months, right, they will just keep the share that they legally own. But if you do pay back, then they'll transfer legal ownership back back to you. So the substance, right, the word substance over form is a word that's commonly used in accounting, even in the conceptual framework. Substance is essentially economic reality of this transaction is a loan that bears interest of 5 over 3 months that is secured by an Apple share. And the substance of the transaction does not follow the legal form, which is a sale. IFRS is designed to capture substance, i.e. is to capture this thing looking like a loan. Now, as you can imagine, the accounting looks completely different depending on how you account for this transaction. So on the one side of things, just imagine Lehman Brothers as a company that is going through extreme financial difficulty and lacks liquidity, to lend a word that Lerato used. And so now they record all of the transactions as sales. So how do they record it? Right, we have cash coming in, so we recognize cash. Right, all the terminology will become even more important, sort of as we go along. So they recognize cash, right, and they de-recognize a share. So when you look at the financial statements of Lehman Brothers, ignoring everything else, you see cash, right, of 100, okay? Versus the other version of Lehman Brothers, where when you account for this as a sale that's secured by a loan, right? The cash comes in, right? So you recognize cash. However, you don't de-recognize a share because Lehman Brothers still controls the share, right? They are merely using the share as security, right? It's a simple thing. It's not simple. It's a similar thing to sort of how houses work in bonds, where if you look at the balance sheet of a bank, a retail bank, you're not going to see a bunch of houses on the balance sheet, even though providing mortgages is I use the word mortgage. Bonds is a key part of a bank's business, right? But you're not going to see PPE or of a house or investment property on the balance sheet. Why? Because they merely hold that as security. Who has that house on their balance sheet? It's the home owner. Or of course, the bank has security over it, so it has title, right? But you ultimately the owner of the home, so you have the home on your balance sheet. Similar thing with the shares. Lehman Brothers would still have the shares on the statement of financial position, right? However, they'll bring in the cash of 100, but on the other side of things, but the other double entry, they would have a loan. So I've got one version of Lehman Brothers that has cash, cold hard cash on the statement of financial position. Another version that has a cash and a loan, right? Those are two very different companies. If I'm trying to make a decision on as an investor or a regulator in terms of what I'm going to do with this particular company, whether I'm going to invest or not. So that is almost using your you're very wonderful, and thanks for sharing. It was extremely insightful. Sort of analysis of the economic reality of transactions. But let's have a look at how IFRS deals with this. So at the end of the day, okay, so now another thing that I wanted to just share, but Lorata did it quite nicely, so I was able to discuss it in terms of thinking about things by analogy. Another thing that sometimes helps is a liking or a kinning or an analogizing to some other thing. So, for example, if you struggle with financial instruments, right, and you struggle to make sense of sort of shares being sold and bought, what you could do is you could just change the fact pattern to something similar. So let's say it's Mercedes-Benz and they sell cars, obviously, the dealership, and then literally you replace the securities for a car. So Mercedes-Benz in December sells a car for 100, the C class, and then at the same time has an obligation to buy back that exact same C class in whatever condition it's in at 105, right? And then you can almost think through it like that, and then you probably get the same place. But Lorata did it with a pen, which is exactly the same concept. So when you struggle with specific transactions, in this particular case, it would be financial instruments, you can liken it to something similar. And then sort of think about it that way, something that makes you more comfortable. And in most cases, of course, it depends on the strength of your analogy, but in most cases, it's a really useful exercise when you're thinking through something. One which I employ myself often when I'm trying to think through something. Okay. So how does IFRS deal with this? So what's the time? 22. So we'll go on for another 15 odd minutes, and then we'll take a break. So it's all well and true that we all came to the answer by just essentially winging it and using our professional knowledge and commercial experience and life experience to come to an answer. But that's not how we answer questions from a financial reporting perspective. We answer questions using the accounting standards. So using your books. And we always are going to have to refer back to the books. But that skill of thinking through the economic reality is extremely important and extremely valuable in the workplace and in your careers, where you're able to not just follow rules like tax, and I say like tax in a very shallow way, right? Of course, tax is extremely complex, and there's case law, and there's a lot of judgment you need to apply when you apply tax rules. But I'm talking about like the baseline tax principles. Okay, that's what I'm talking about. I don't mean to offend any tax professionals. But now I lose my train of thought. Yes, not only is it important for you to understand sort of the principles and where to find the principles, right? And learn the why of the principles. You keep that skill of thinking about the economic reality always in your back pocket. Because sometimes, right, the IFRS and don't look at these IFRSs like it's there's another way of doing it. This is the right way. This is the only okay. It is kind of the only way when you're applying IFRS, but it's not to say that this is like it, right? This is like the perfect framework that could have ever existed, that has ever existed, right? That's not the case. Sometimes you do get some counterintuitive outcomes when you apply IFRS, but it's always great to have that ability to sense check an outcome, right? Like, okay, fine. When I apply the IFRS and I apply my judgment, I'm getting to this answer. But does it actually reflect the economic reality of what we're doing? Because where I understand it, it works like X, Y, Z, or it looks like that, but now I'm reporting it like this. Does it make sense? That sort of interplay is always an important sense check for yourself. Is my conclusion making sense, and does it reflect the economic reality of what's happening? Okay, cool. Back to the reference. Now I'm trying to think. Probably the best way for me to do this is to skip a little bit. To here. Okay, and then we'll take a break in the next 10 minutes. So I'm just going to introduce this slide. So the thought process. So what have we done so far? What we have spent a lot of time doing is the first little item here, which is identifying the issue, identifying the transaction, identifying the problem, critical thinking, right? You looked at something, right? I asked a bunch of questions. I hope you're asking the questions yourself in the background, but I asked questions to prompt some thinking, not to say that you weren't doing some thinking yourselves in the background. But then in doing so, we were identifying issues, right? So how do you identify issues? You just ask questions, right? And once you identify an issue, a transaction, it could be a transaction, it could be an event. So something usually happens, right? Like a past event happens, which creates an issue, which creates a phenomenon. Question is, do we need to report on this phenomenon, right? Then that's where the next three little circles come into play. How do we know whether or not we need to report on this phenomenon? So we had this transaction where we had shares, we sold the shares, we bought back the shares, and so that's the phenomenon. Do we need to report on this phenomenon? The first question you need to ask, the second question you need to ask yourself then is, okay, cool. How do I check? The answer to that is, it's in the IFRS, right? You need to check the books, those books that Tom described at the beginning. You need to check the books. Then it's like, whoa, but like, there's so many books. How do I know which one, which standard, right? So now what becomes very useful is obviously having a way to break down the standards, which we'll cover shortly. But then there's a very important part of the standard that deals with scope, right? And the scoping part of the standard then says, okay, if you've got this transaction, you're in this standard. If you have this transaction, you are not in the standard. Go to that standard instead. Can't tell you how important this step is. Mess this step up, you're dead even before you've started. You have shares, and you're accounting for them as if they were Mercedes-Benzes or pens, right? You're in big trouble already from the beginning. You're walking away with nothing, essentially, right? You might as well not have responded to the question, type of thing. unless the question was which standard, then you pretty much kind of respond to the question. Okay. But my point is, identifying which standard you are in or you should be in is a crucial step. Now, depending on your background, by background, I mean how you've sort of progressed in this professional program, whether you've come the traditional route through ITC, whether they've come through CIMA, so you have a little bit of accounting experience, whether they've come through ACA with a lot more. Usually the training to date has done this exercise for you, right? So the question will say, discuss how you account for this intangible asset in accordance with IAS 38, right? It told you which standard to use, right? The work is done for you. At this level, that's not going to happen, okay? So that's a part of the standard we need to become comfortable with, and we're going to deal with that after the break. Then once you know which standard you're in, right, it's then dealing with the accounting treatment. But what I think we often overlook is we jump straight into the accounting treatment of a transaction, but we overlook the objective of the standard, the why. So just like with IAS 36 earlier on, in payment of assets, when we were talking about Tonguard, and I said, okay, but hang on, what if I don't have an indicator of impairment here? That's listed as one of these examples. How do I know whether or not my feeling, my concern that this asset is overvalued is valid? Okay. I'll know it's valid if I understood the objective of IAS 36, right? And we read it together. The objective is to ensure that the carrying amount of an asset does not exceed its recoverable amount. So if I've got this concern using my professional judgment that there's an indicator of impairment that is not listed as one of those examples, then to meet the objective of the standard that I've been scoped into, I have the responsibility to still perform an impairment test. ITC type or potentially ACA as well. I'm not super close, but I do have a high level understanding of the ACA program. We'll probably list an example of an indicator of impairment that is one of the examples in the book, right? Why do they do that? You want to reduce professional judgment in the exam because you want to standardize the assessing, right? You want to have one solution. When you allow for professional judgment inexplicably allows for different views, right? And we'll see that in this session as well. And then that then causes havoc for someone assessing in a very black and white environment. At an APC level, we test black and white. So we test how are you able to navigate these areas that are not necessarily codified in the standard. We test judgment. Right? So to apply judgment, not only do you need to have that professional knowledge, so understanding how a mashonisa works, understanding how a loan works, understanding how a sale works, you need to have that. But you also need to understand the objective of the standard that you're trying to apply. Put that together, then you're a step closer to applying judgment. But we'll jump into the nitty-gritties of accounting treatment after the break. Then lastly, someone mentioned it in the chat. It's, and I think in a response, it's not just about accounting for stuff. I mean, accounting for stuff is fun, right? Journal entries are cool. But when is the last time you picked up a set of financial statements and you saw journal entries in there, right? Probably never. I think I can comfortably say that I've never seen a journal entry in a set of financial statements. I haven't seen all financial statements in the world, but I've seen quite a few, and I haven't seen a journal entry in there. What have I seen in there? I've seen financial statements presented, right? I've seen the income statement, statement of other comprehensive income, statement of financial position, statement of change in equity, cash flow statement, right? Then I've seen note disclosures, right? And that is ultimately the product of financial reporting. So not only do we account for stuff, we also present and disclose stuff. Why do we present and disclose stuff? To facilitate decision making. So what is an extra element that will become important for us as CAs going into practice is how do we present, I mean, obviously assuming you stay in accounting, how do you present things in the financial? Journals are important, but presentation disclosure is as important. And typically in the training, whether it's ITC, which is evolving now to IAC, and ACA, there's much more focus on the accounting side of things, but typically a little less on presentation disclosure. But of course, that's evolving now. But at an APC world, we're squarely in it. Presentation and disclosure is extremely important to understand how that all works. Okay, so 4 key pillars regarding the thought process of how to deal with accounting, or rather how to deal with phenomenon that companies or reporting entities experience. Okay, I'm going to pause here for a 20-minute break. Any questions before we break? Cool. So the time is 10:33. Let's be back at 10:53. See you soon.